Welcome back to The Explainer. Today, we're going to be exploring a fascinating shift in perspective, one that can completely change how you view your livelihood. We're talking about escaping that fragile, highly stressful dependence on a monthly salary and transitioning into a totally new paradigm, a paradigm where you build perpetual income-generating assets. If you've ever felt, just tethered to your job, well, we're going to unpack exactly how you can build your financial architecture differently. Okay, let's dive into this. I want you to consider a pretty uncomfortable question. How long could you actually survive if your paycheck just stopped tomorrow? If we're being completely honest with ourselves, for most people, the savings run out in anywhere from 2 weeks to 3 months, max. The bills keep coming and the situation becomes genuinely urgent. Why? Because your entire financial life is being held together by a single, incredibly delicate mechanism, exchanging your time for a paycheck. And that brings us to the core distinction we're looking at today: salary-based living versus asset-based living. Look, a salary is not an asset. It's a fragile, finite agreement. As long as you show up and perform, sure, you get paid. But the very second you lose your job or your employer just changes their mind, that agreement goes poof, it's gone. Assets, on the other hand, they're categorically different. They provide perpetual output regardless of your daily physical participation. They pay you whether you show up to an office or not. Section 1. The 4 asset pillars, building the foundation. You see, the genuinely wealthy, they don't rely on a single stream of income. Instead, they spread their foundation across 4 distinct pillars: equities, real estate, business ownership, and fixed income. By combining these multiple streams, their income becomes incredibly resilient. It's never overly dependent on a single variable or some random fluctuation in a single market. So what exactly does each of these pillars provide? Well, equities generate regular dividends. Real estate, that provides your monthly rent. Business ownership provides profit distributions. And fixed income, stuff like bonds or even alternative assets like intellectual property, generates reliable interest and yield. Usually that sits around a highly predictable 4 to 5% in the current market. Now, what's really interesting about this is the pure math behind equities. Let's say we're looking at an income target of $70,000 to $80,000 a year. If you build a $2 million stock portfolio with a conservative 3.5 to 4% dividend yield, it generates that exact amount in annual income. And honestly, the most brilliant part, it does this without consuming your principal. The original $2 million stays completely intact, doing its thing, while the income just flows out to fund your lifestyle. Then we have the incredibly tangible power of real estate: $24,000. That is what a single rental property generating a pretty modest $2,000 a month in net income produces in a year. And not only is this highly predictable month to month, but it acts as this built-in inflation hedge. Over time, rents generally tend to rise, right? Meaning the income from this single asset grows, while your fixed costs, like your mortgage, remain totally steady. For a third pillar, we kind of need to be precise about our definitions. True business ownership is ownership of an entity that generates returns systematically, regardless of the owner's daily physical presence. Listen, creating a demanding, high-paying day job for yourself where you still have to do all the heavy lifting, that is not an asset. True business ownership means building something, maybe a private equity stake or a silent partnership that actually runs on systems and management. Section 2. Demystifying the buy, borrow, die strategy. It's totally fascinating how this works. This is a highly sophisticated yet entirely legal framework used to sustain wealth, and it breaks down into 4 logical steps. Step 1. You buy assets and just let them appreciate over time. Step 2. When you need cash to live on, you absolutely do not sell the assets. Instead, you borrow against them using a securities-backed line of credit. Step 3. By borrowing instead of selling, you legally defer capital gains taxes indefinitely. And step 4, at death, the assets pass to heirs with what's called a step-up in basis, completely wiping out the accumulated capital gains tax on that entire lifetime of growth. And this brilliantly illustrates exactly why this mathematical strategy works. Imagine a family living off a $100 million stock portfolio. They don't sell $3 million of stock and trigger a massive tax bill. No way. Instead, they borrow $3 million at a 4 to 5% interest rate. Because their portfolio is historically returning, say, 7 to 10%, the net return on their collateral actually exceeds the cost of the loan. They literally fund their entire lifestyle while keeping their wealth completely intact so it can keep compounding. Section 3. The James Case Study, a 20-year journey. Now let's bring this down to earth and trace a relatable, grounded example. Let's look at James's exact timeline over 20 years. In year 1, he automated investing a fixed percentage of his regular salary into index funds. By year 5, he diversified and bought 2 rental properties. By year 10, he built a consulting LLC that he systematically stepped back from. And by year 20, at age 53, his passive income finally matched his salary because he reinvested all his dividends for 15 solid years. When his corporate job offered a severance package, he took it, effortlessly, without any of the anxiety that would normally paralyze someone in that situation. I absolutely love this quote from the source material. What was exceptional was the consistency, the refusal to let lifestyle consume every dollar. James didn't inherit a massive windfall. He didn't win the lottery. He achieved his freedom by simply decoupling his financial security from his employer through consistent, completely ordinary actions over 2 full decades. Section 4. Your Asset Building Blueprint. An actionable framework. So the crucial point is following these 4 incremental steps to safely make the transition from salary dependent to asset independent. Step 1 is calculating your target. Step 2 is building your stream sequentially. Step 3 is reinvesting everything you earn. And step 4 is carefully managing that eventual transition. Let's break down the math for step 1. To know where you're going, you need an exact target, right? If you want to replace an $80,000 living expense, look at the required assets based on different yields. At a very conservative 3% yield, you need $2.67 million. At a standard 4%, you need $2 million. At a slightly more aggressive 5%, you need $1.6 million. These aren't just arbitrary numbers plucked from the sky, they are precise, totally achievable portfolio targets. Now for step 2. The key here is to build sequentially. Don't overwhelm yourself trying to do the whole shebang all at once. Start with the most accessible step. Maximize your retirement accounts and low-cost index funds first. Once that's running on autopilot, add a cash-flowing rental property to diversify away from stock market volatility. And then, later on, you can systematize your existing professional expertise into structured business income. Step 3 is literally the engine of your wealth. Reinvest everything. Reinvested dividends double your income production roughly every 7 to 10 years. It's like a giant snowball rolling down a hill. The compounding power of keeping all asset outputs strictly reinvested until that income is absolutely necessary, that is what accelerates you toward financial freedom. Section 5. The ultimate mindset shift. Asset-based thinking. This right here is the fundamental psychological shift in how you view the money hitting your bank account. For salary-based thinkers, income is simply something to be spent. Money comes in, money goes out to maintain a lifestyle, and the cycle just repeats itself endlessly. But for asset-based thinkers, income is something to be deployed. They have this relentless habit of taking income in cash and permanently converting it into income-producing structures that are going to pay them forever. Which brings us to this incredibly powerful realization. The paycheck is not the destination. It is the raw material. Your current salary is exactly the fuel you need to build your lasting independence. The upper class didn't get there by finding some magic trick. They got there by treating every single paycheck as the starting point to literally buy their freedom. So I'm going to leave you with this final provocative question. Will you consume your next paycheck, or will you use it to build your freedom? The assets that make you free begin with the exact same paycheck sitting in your account right now. If this explainer helped you grasp the mechanics of asset-based living, please hit that like button, share this with someone who is still trading all their time for a salary, and be sure to subscribe so you don't miss our next deep dive into structured learning. See you next time.